Hi everyone, this is Stuart. Hope everyone enjoyed their weekend. On this week's update, we'll cover the Fed's rate cuts, earnings updates, valuations, spending on artificial intelligence, and signs of a bifurcating economy. To start, the Federal Reserve delivered its second 25 basis point rate cut in as many meetings last week, bringing the Fed funds rate down to 4%. While this move aligned with market expectations, Chairman Powell surprised investors with a pointed comment that expectations of another rate cut at the Fed's next meeting in December was far from a foregone conclusion. Despite that, market participants still expect another cut this year, with longer-term rates falling to 3%. We'll be sure to follow any risks to this trajectory. On to earnings. After a busy last 2 weeks, so far so good. Roughly 3/4 of S&P 500 firms have beaten estimates, and 43% have guided to earnings growth above analyst expectations. For the quarter, year-over-year earnings growth is tracking at 8%, led by large technology firms, with 2026 expectations for earnings growth rising to the mid-teens. As we've said over the years, markets tend to track earnings growth over the long term. However, valuations still matter. And on the valuations front, it's hard to argue that some pockets of the market are not getting a bit extended. For instance, the tech-heavy NASDAQ 100 index is trading at 30 times next 12-month earnings expectations. That's the 99th percentile of its valuation range over the last 20 years. Given the growing weight of tech in the S&P 500, where now the top 10 firms comprise over 40% of the holdings, that index at 23 times forward earnings is also trading at a premium valuation relative to its 20-year history. In fact, the S&P is now trading at the 96th percentile on a PE basis over the last 30 years. None of this is to say that such valuations can't persist or are unjustified. The market is pricing in substantial growth, much of which is predicated on the build-out and application of artificial intelligence, and so far, all the near-term growth estimates have actually proven too conservative. That said, there are both emerging opportunities on an absolute and relative valuation basis that we're watching, such as energy and healthcare, both of which are key parts of the AI story themselves, from power supply to the application of AI into trial designs and patient care. Additionally, within certain sectors, the valuation dispersions are creating potential opportunities. Within technology, for instance, many mature and quality software stocks are trading at historically low valuations due to concerns that AI poses an existential threat to their business models. We're not quite convinced of these risks and think there's an opportunity for many firms to enhance their offerings by embedding AI capabilities. Please let us know if you'd like to separately discuss some of the stocks where we think investors are too severely discounting longer-term risks. Returning to a common theme, capital expenditure numbers for the leading AI firms and data center hosts keep going up. The top 6 US spenders are now expected to hit $434 billion in CapEx this year and grow CapEx an additional 60% to $700 billion by 2027. These numbers are astronomical and explain why firms that have any tangible relationship to AI infrastructure are performing so well. If you listen to the companies and their executives on earnings calls and in public interviews, the supply of compute cannot keep up with demand, with power remaining the key holdup. We think that problem is solvable, but will take time for reasons ranging from site permitting to supply chain bottlenecks. So long as companies are generating revenue tied to their spending, which at least for Microsoft, Amazon, and Alphabet is the case, we expect the spending to persist and shareholders to reward the investment. For companies like Meta, however, where the spending has not yet resulted in a leading model or any cloud revenue, shareholders may not be as forgiving in the near term. Lingering in the background is a question as to how all this spending gets financed. For OpenAI and Anthropic, we think it's a legitimate question as their revenues, though impressive, are nowhere near reaching the same level of their next 5-year spending commitments. Key to watch is their revenue growth and continued private investor and partner enthusiasm to finance their expansion. For the public firms involved in the space, they have the capital to support this AI build-out, but it's consuming an increasing percentage of their operating cash flows. CapEx plus dividends and share buybacks are now close to consuming 100% of the operating cash flows of Amazon, Alphabet, Meta, Microsoft, and Oracle. Again, we think this investment cycle makes sense as AI has the potential to unlock incredible economic value. but higher spending levels leave less room for any disappointments. We would get cautious if we see these firms aggressively turn to debt markets to finance their investments. Finally, we wanted to highlight how the economy, which is performing well in the aggregate, is increasingly becoming dependent on this AI investment cycle for growth. Business investment in tech equipment and software accounted for over half of US GDP growth through the first 2 quarters of the year. Meanwhile, we've started to see data pointing to consumer weakness and a deterioration in the labor market, including some sizable job cut announcements at companies like Amazon and UPS. Safe to say, there's a lot riding on the current AI investment wave. As users of AI, we remain optimistic about its potential benefits, but we won't let that distract us from incoming data and prudent risk management. If you have any questions about today's discussion, please feel free to reach out. Thank you, and have a great start to your week.